A lot of business owners take for granted that the reports they run in QuickBooks Online are accurate. But unfortunately, just because you pull a report in QuickBooks doesn't mean that it is truly representative of the reality of your business at any given time. Your reports are only as good as the data that goes into them, and it's really important that we verify that data and make sure everything is complete and correct before we start analyzing our reports to make decisions in our business. So today, I'm going to walk you through exactly the steps that I take, both in my own books and for my clients, to verify that information is complete and correct before I let them know that their financial statements are safe to review. So the first things first, basically all of our work today is going to be in the reports section of our QuickBooks file. So I'm going to go over here to the left-hand navigation menu and click on reports. Now, a lot of our reports that we're going to be working with are standard reports. They're quick and easy to pull, okay? But I do highly recommend, if this is something you're going to want to take on a regular basis, making sure that some of these reports are up here in your favorites section so that you can quickly and easily find them, okay? Now, the absolute first thing that I would recommend doing is reviewing your reconciliation reports, okay? You're going to want to look at your reconciliation reports for all of your cash and loan accounts to ensure that everything is complete and up to date. If your reconciliation reports are not yet in your favorites, I definitely recommend adding them. It's very easy to add reports to your favorite reports. All you have to do is scroll down to the section where you would find it and then put the little green star next to it, okay? Now, my reconciliation reports are already favorited because I rely on these constantly. But if you don't have them, you're going to scroll down all the way to For My Accountant, all right? And do not be afraid by this section. This section contains a lot of reports that are really key and critical to running your business. Don't overlook it if you're not an accountant. So right here we have our reconciliation reports. We're definitely going to want to favorite that because that's something that we're going to end up using to make sure that our reports are complete. Another one that I would probably pull to the top at this point if I didn't have it there already is my accounts receivable aging summary, okay? When it comes to verifying whether or not our books are complete or correct, our accounts payable and accounts receivable aging summaries are great places to start because if there is outdated information on those, it could be negatively impacting our reports, especially if we operate on accrual basis. So now that I have all the reports that I want to use to verify my books up at the top, and we're also going to be looking at our balance sheet and our profit and loss, okay? Now that I have all of that up at the top, I am going to start reviewing, and I'm going to start with my reconciliation reports. So if I click into reconciliation reports, it's going to default to whatever the last account that I was dealing with was. Now, you can always just start and go through your reports, but I recommend working through your reports on the same order that they're going to be showing up on your balance sheet. Now, I've done a video on how to read your balance sheet. I will link it, but at the end of the day, you're going to go in order of liquidity, right? So cash accounts, savings accounts, and then you're going to move on to anything else. So credit card accounts, loan accounts, all of that. So instead of having Toyota Prius here, the Toyota Prius loan, I'm going to select my checking account from the drop-down menu. Because if there's a problem in my checking account, it's possible that a problem is flowing through to my other accounts. So how am I going to verify that this is correct? I'm going to click on View Report right here on this on the far right-hand side of my screen. And what am I looking for once I get here? Well, in an ideal world, we're going to have all the information we need right at the very top of this reconciliation report. If I have my statement ending balance and my register balance lining up perfectly, that means that all of the transactions for this report are in through the reconciliation report ending date, right? In this case, it would be 5/31 of 2026. So basically what this tells me is that I have accounted for all of the transactions that have come into my checking account or left my checking account. And there are no uncleared transactions on my books. Now, to be fair, While this is the absolutely ideal situation, there are some instances where you might see a difference between your statement ending balance and your register balance. Critically, if you still write checks, and especially if you use QuickBooks to walk through that workflow where you're paying bills and then printing checks so that they're recorded in your register and then sending them out into the world, you might, if you send a check out towards the end of the month, see uncleared checks on your reconciliation report here. That is completely fine, okay? At the end of the day, it isn't as critical that your register balance and statement ending balance match up exactly as it is that any uncleared transactions, any open amounts make sense and you can speak to them, okay? So, for example, if my register balance were showing, $28,319.03 instead of the statement ending balance of $130,319.03, that might tell me that I have a $2,000 outstanding check. And if that's the case, no problem. That check will hopefully clear in the next cycle and we'll be all set, right? Where it becomes an issue is if we have things staying on for long periods of time or if they're not easily explained. So, for example, if we're not seeing payments or deposits clear that were sent by ACH, that's a problem. We would need to address why we're not seeing those things clear out on a monthly basis. So that's the first step, is making sure that our statement ending balance and our register balance match up, or if they don't, it is for an easily explained reason. Now, on another account, on a credit card, we might see something, and we'll get into this in just a moment when we look at the credit card reconciliation. So once we are in this screen, we can actually just select from the drop-down menu the next account that we want to look at right here. So we don't have to go back out to history by account and switch accounts. So I'm going to look at my savings account now. And same thing, my statement ending balance and my register balance are right on. This tells me all of the transactions have been accounted for and I'm all set. Let's go ahead and move on at this point to our credit card account. Now, I will say this, because I have my credit card for this sample file set up and I'm running things in and out on it through the bank transactions tab, I don't have any examples of an instance where it is off, but we're going to talk about this just a little bit. So again, my statement ending balance and my register balance as of the statement ending date are right on. So this tells me that I'm all set, right? Everything is in and accounted for. There are some credit cards where occasionally a transaction or two that happens towards the end of the statement won't clear until the next statement. So if the statement ends on the 31st, but the 31st also happened to fall on a Saturday, sometimes those transactions might show up on our register when it comes through on our bank feed as having happened on the 31st, but they don't clear until the 1st or the 2nd because that's when our bank picks back up with processing. So we could actually see a split across credit card statements where a transaction was charged on the 31st, but it didn't clear until the next day. Or, in this case, this statement ending period is the 11th through the 10th. So I could charge something on the 10th and it might not clear until the 11th, okay? Things like that do happen. Again, a difference is not the end of the world. The part where it becomes the end of the world is if it is ongoing and unexplainable, okay? If I can go on and see that that is on my next statement, no problem. I'll reconcile it on my next statement and everything will be fine, okay? In my experience, the bigger offenders on this tend to be CitiCard and Spark Card sometimes have some issues with that, okay, where something will not quite clear exactly as it comes through on our bank transactions tab. Again, don't panic, but if it is going on over multiple months, if we have a transaction from months back that hasn't cleared and isn't explainable, we want to be able to adjust that and fix it so that our reports are complete and accurate. Now I'm going to go ahead and move on to my loan accounts, okay? So I have two loan accounts on my books here. I have this loan for the 2026 Toyota Prius, okay? And again, we want to be seeing the same thing. We want to be seeing the statement ending balance and the register balance lining up. Now, I will say this. For some of my clients, we don't always reconcile their car loans every single month. And the bottom line is, in this more modern day and age, we're not always getting monthly statements for these things. When I started in accounting 10 plus years ago, I used to get a statement from the Toyota vehicle that the business owner had purchased in the mail every single month. So I was able to recognize the interest and the principal payments right then and there. That's less prevalent now, and sometimes depending on how you go about getting financing for your car, those statements are not as readily accessible. So one thing to keep in mind here is that if you are not reconciling a loan every single month for whatever reason, right? If you are able to, I always recommend it, but some loans, some lines of credit, some other ways of taking on debt basically don't always issue monthly statements. So it's not always possible to reconcile every single month. The important thing is to do this at least, at the very minimum, once per year, because if you have a loan and you're making payments on it, you are almost certainly paying interest. And interest is a deductible expense to you and to your business. So you want to be recognizing that expense. If you can recognize it every month, it gives you a much better idea of where you stand and what your actual cash flow is in your business. But if you're only doing it quarterly or every 6 months or annually, as long as it is getting recognized at regular intervals, that's just fine. So for certain kinds of loans, you might not be looking at the most recent month end, but you still want to be able to point to a point in time when your statement ending balance and your register balance lined up, okay? So because I am absolutely neurotic about these kinds of things, my sample company has loans that get statements every month. So I am reconciling these accounts every single month. Now we're also going to look at our other loan, which is our SBA loan. And once again, same thing, we're seeing our statement ending balance and our register balance being dead on accurate, okay? This is, in an ideal world, what we want to see. I know that this is a sample file. I've kind of created my own little sandbox where everything gets to be ideal. So if your reports are not reflecting this at this point, please do not panic. It is definitely something that you might have to work towards depending on what else is happening in your business. So if all of your reconciliation reports have the statement ending balance and the register balance lining up, that is the first step to being able to trust your reports, because that means that all of the transactions that happened in those accounts have been recognized on your books, okay? After you've gone through that process, we're actually going to head back to our standard reports. And we're going to look at our two accounts payable and accounts receivable aging summaries, okay? Now, if you are on cash basis, these reports are not quite as good an indicator of the accuracy of your books, okay? Where these reports shine on cash basis is letting you know if somebody has owed you for a long period of time and hasn't yet sent you payment so that you can follow up with them and hopefully get your money. And if you have accidentally forgotten to pay somebody for a longer period of time, right? But if you're on accrual basis, these reports are actually big indicators of the accuracy of your reports. And we'll discuss why once we open up each one. So we're going to start with our accounts payable aging summary, okay? Basically, what we're looking for here is we are hoping to only see things in the current or maybe in the 1 to 30 aging, okay? So current means that this bill is not yet due. If it is in the 1 to 30, that means that it is 1 to 30 days past its due date, and then onward, right? 31 to 60, 61 to 90, and 91 and over. Again, I hope that you don't have anything hanging out in the over 30 aging bucket, right? Sometimes we might see something where we processed a payment online and it took a couple days to clear. Maybe it's actually fine, maybe it's not late, but we're just waiting for that all to come together. That is totally fine. But if I, as a business owner, had somebody sitting in the 31 to 60 day range that I hadn't paid, I would feel so guilty. So I really want to make sure that I am checking these reports on a regular basis to get these things paid and get everything moving along. Now, Here is why these reports are so critically important on an accrual basis. If I am working on accrual basis accounting, that means that I am recognizing expenses and income as soon as those transactions are recorded on my books. So as soon as I enter a bill or as soon as I send an invoice, I am recognizing that expense or income accordingly, okay? So what happens if we have something on one of these reports that's in the 61 to 90 or 91 and over, and we know that we already either paid that bill or we already received payment for that invoice? Well, that means that something has gone wrong somewhere else on our books, okay? In all likelihood, what that means is if I had something in the 61 to 90 and 91 and over and I knew that I had already paid the bill, what that probably means is that when the transaction came through my bank feed, I classified it as an expense instead of matching it with the outstanding outstanding bill. If I did that, that means that I effectively duplicated that expense, which is going to mess up my profit and loss report. Same with our accounts receivable. So let's go ahead and dive into that right now. Again, in accounts receivable, we are hoping always that we have as little in accounts receivable as possible because we want our customers to pay us in a timely fashion, okay? So in this particular instance, I do happen to have one in the 1 to 30 aging range, and then I have one in current. So that is as close to ideal as you can possibly get, okay? And honestly, for this one in the 1 to 30, when I was looking at it earlier, I think that the due date was technically, the due date was June 1st. We're only at June 4th. So as far as knowing whether or not something is accurate, we don't have to stress too much if it's only a couple days past due. That customer might have put a check in the mail on the 30th of June, which technically would have been on the 30th of May, which technically would have been well within their window, and we might just not have received it yet. Okay, as a general rule, I don't tend to start stressing about stuff like this until we get to about the 10 to 15 days past due mark, okay? But again, if I have something hanging out way over here and I know that the customer already sent me that payment, that's an indication to me that something else went wrong somewhere on my books. Again, when that came through on the bank feed, maybe I classified it as income instead of matching it up to this outstanding invoice. And that would mean that I had duplicated my income, which I definitely don't want to be doing. So these reports help us to identify whether or not there are any inaccuracies on the books, okay? Once we've gone through all this, once we've looked at our reconciliation reports, and once we've looked at our accounts payable and our accounts receivable aging details, we want to do a quick skim of our profit and loss and balance sheet to see if there are any things that might be kind of red flags. So let's go look at that really quickly. I would go back here to standard reports, and then I'm going to look at, we'll start with the balance sheet. I tend to like to start with the balance sheet personally. And here's what I would be looking for on the balance sheet, okay? I don't want to see, for the most part, negative amounts on my balance sheet, okay? Again, there are a couple of exceptions to this. I might see a negative amount in an accumulated depreciation or amortization account, which would be in the fixed assets section, okay? That is totally fine. And I might see some negative numbers down here in my equity section, okay? Again, that is okay. In an ideal world, we're going to have positive numbers everywhere because we want our net income to be a positive number. We want our retained earnings to be a positive number. I guess it would be fine if our owner investment account went into the negative because that would mean that we got to take money out of our business, which I'm personally always a fan of. I love earning money. So that is possible. But we don't want our accounts payable to be a negative number. We don't want our accounts receivable to be a negative number. If those are negative numbers, that's an indication that something has gone wrong somewhere. Also, we don't want our cash accounts or our credit accounts, our loan accounts, to be negative, okay? Occasionally, when you get close to the end and you're paying off a loan, it will actually dip into the negative briefly until you split out that final payment for interest. But if I see a negative on a balance sheet for a long period of time, that is an indication to me that something somewhere has gone wrong or something hasn't been completely reported. So there's that. Okay, since I have no negative numbers on here, I feel, and I've already reviewed the reconciliation reports and my accounts payable and accounts receivable reports, I feel pretty good about this, and I feel like I could start to use it to make decisions for my business. So that's wonderful, and that's the whole goal. We want to be able to use our reports to make educated and timely decisions in our business. That is the whole point of what we are doing here. So now that we've done this over here, let's go ahead and look at our profit and loss report as well. Now, the profit and loss, the red flags there are effectively the same as the red flags on the balance sheet. For the most part, we don't want to be seeing negative numbers on our profit and loss, okay? Couple exceptions. One, if we have a refund account, we might have a negative income amount. But that would be for if we were refunding customers and we wanted that to be a separate metric and not just be booked back against the income account that was originally used. So that is absolutely fine. We might see a negative refund account. And occasionally, especially if we're looking at our reports on a month-by-month basis, we might occasionally see a negative balance in an expense account, okay? Now, let's go ahead and talk about an instance where that might happen. Let's say that I went to the store and I bought $500 of toner for my printer, which I wish was an exaggeration, but it's really probably not in the grand scheme of things. If it turns out that I had purchased the wrong cartridges, I went in on the 30th of May, I purchased those cartridges, and then the next month I went in and returned them because they weren't the right ones. Well, I might briefly see a negative number in that expense account if I hadn't yet spent at least $500 on my office supplies for that next month, okay? It's not the end of the world, but again, it's just something that we want to be aware of and be able to speak to, because a negative number on an ongoing basis usually means that something is being classified to that account that shouldn't be. So again, since we don't have any negative numbers here, we don't have anything that is, screaming incorrect or causing me to think that these reports are not reliable, we can start to use these reports to make decisions in our business. All right. Thank you so very much for watching. I'm Holly from Accrual Mistress Bookkeeping and Consulting. If you found this helpful, please do like and subscribe. And if you have any questions, leave those in the comments below. I will absolutely get back to you.